right, everyone, thank you for coming today. Good to see you, and I hope you're ready for Thanksgiving next week. Wanted to introduce one of our CFA Society Virginia members and board member and treasurer as well, John Ellison. So John's presented to the CFA Society Virginia in the past, and looking forward to his update as well. So he's going to present on a Quant's perspective on technical analysis. So John is the co-founder and managing member of Richmond Quantitative Advisors, a quant investment management firm based here in Richmond. He leads the development, management, and execution of quant-based strategies in multi-strategy portfolios. He has over a decade of experience researching, developing, and managing quantitative strategies, and he holds a BA from the College of William & Mary, and as I mentioned earlier, he is a fellow CFA charter holder. So with that, John, I'll transition it to you.
Thank you, Ashby. I think I guess I'll walk around a little bit. Thank you for the nice introduction. Again, my name is John. Glad everybody came out here today. It seems like it's a pretty good turnout. Hopefully this is, especially in the market that we're in right now, pretty interesting topic. Hopefully it won't just be like watching paint dry as I stand up here and talk. Let's see here. Is that not working? Yeah, do you mind? Yeah.
How many CFAs does it take to fit? I just clicked right there. I was trying to do it here.
Interesting.
There we go.
Okay. Okay, now we're good. Okay. So I'm here with my partner, Andrew. He's there in the back. We launched about 5 years ago. Like Ashby said, and like our name implies, we're based here in Richmond. We run a lot of quantitative investment management strategies. Most of what we do these days is manage portfolio solutions. We handle things for advisors and financial planners, do holistic portfolios. We also have strategy-specific, unified, and separately managed accounts. We have a proprietary hedge fund that we manage, and we also embark on research and consulting engagements as well. So I know I'm here to talk about technical analysis. I think it's going to help round things out for me to talk about where my perspectives started and how they've evolved over time. And this still, has a touch of a soft spot. If we look back to 2007, right before I was about to graduate from undergrad, I was a Warren Buffett, Benjamin Graham value disciple. Made all the sense in the world to me. Was learning as much as I could about valuing companies at the time. Was starting to look into the CFA program as well. I was lucky enough to still have a nice sizable portion of my college fund that it was nice to have my parents and grandparents set up for me to help pay for a lot of the tuition at William & Mary. And it just so happened that one of the best performing stocks in that portfolio over the years was General Electric. Now in late 2007, General Electric, largest position that I held by far, it's the largest company in the world. It's about $475 billion in market cap, had a $40 per share stock price. I guess it was $425 billion market cap. Lots of you probably know exactly what happened after that. I thought that this was one of those companies that you could just hold on to forever. It was a known. GE was just a bellwether, that a force to be reckoned with. It was a Warren Buffett, Berkshire Hathaway holding company. And at the time in late 2007, before a lot of the off-balance sheet things started to unravel, it had a very sound fundamental profile. This hurt quite a lot. It went down 85% in value in a matter of about 18 months. So here's a value trade all my own. So in the midst of all the global financial crisis, I was doing a lot of stock screening, fundamental screens, trying to filter down to what looked appealing. And it just so happened I found a lot of the dry bulk shipping companies were, they had great fundamentals, great cash flow. Ocean freight, symbol OCNF, just was this, it stood out to me. They had $3 per share in cash on their balance sheet. They had take-or-pay contracts that average duration of about 4 years. What that meant was whether their ships were shipping anything or not, they were going to get paid on those 4-year contracts. They were trading about $5 a share. So remember, 3 of that was cash. I was like, this is a no-brainer. Ran a lot of my valuation models. I thought the company was probably conservatively fair value around $15 a share. There's a spoiler down here. We already kind of see what happened. Went down from 5 to 4. If I liked it at 5, I love it at 4. Went down to 3, reluctantly bought a little bit more, kind of chopped around from there. I couldn't take it anymore. It sold out at $2.50, roughly. Took about a 50% loss. I was glad I did that. It went down below $1, kind of hovered, bounced around between 30 cents and 60 cents for the next several years. This guy that I worked with, a friend of mine, he was kind of making a jab at me, and he said, hey, Ellison, how's old ocean freight treating you? And I was like, I haven't looked at that stock in years, but it piqued my curiosity, and I was like, let me go see what's happening with them. Look them up on Yahoo Finance, can't find them. Ticker's not there. But I find in the news that dry ships had acquired them for $19.85 cash. So my analysis was right. Actually, it was conservative. I just didn't wait around long enough. So lessons learned were, it kind of brings me back to that Mark Twain quote where it's like, it's not the things that you know that get you in trouble, it's not the things you don't know that get you into trouble. It's the things you know for sure that just ain't so. GE was a prime example of that for me. And then when it came to things like ocean freight, even though the analysis was there, the fundamentals were there, I was right. I didn't have the intestinal fortitude to stick with it, it traded 95% down, so I don't know how many people could actually stick with that. But even though the analysis was right, that was less than even half the picture. You had to have the conviction. And in a way, there's sort of a dichotomy there, because to have that conviction, what do you not know? And that was what was in the back of my mind the entire time that it was going down. It's like they have $3 per share of cash on their balance sheet. They have all these contracts. They're making money. But the street keeps selling it down more and more and more. So shortly thereafter, I went to work for a wealth management firm. We had a lot of institutional and ultra high net worth clients. We called them individuals. And these folks had access to some of the most exclusive funds in the world. And so we got to kind of peek behind the curtain at what these guys did. And the more we interviewed folks like this and we learned about what they did, I learned essentially all of them had a process, a clearly outlined process. Many of them are highly diversified, did multiple different strategies, multiple different alternative strategies, and many of them were quantitative. And if you look at the top hedge funds, these are the top 20 hedge funds in the world based on assets under management, the top half is absolutely dominated. I think it's the top 9 of the top 11. 9 out of the top 11 are all quants. Now, why is this? Well, Two Sigma is one of the premier quant funds. We got data for them performance-wise back through 2004. I'm not going to really talk too much in terms of statistics on these charts, but it's pretty apparent that they have outperformed the S&P 500, Berkshire Hathaway, that's sort of, just a quasi benchmark there. And they've done it with a lot less risk. I think actually to speak statistics, I think their Sharpe ratio since 2004 has been around 2.8. In comparison, the S&P is right around 0.5, 0.6. D.E. Shaw, similar story. The Mac Daddy of them all, Renaissance Technologies. I know I'm committing a lot of chart sins right now by showing it this way, but this is just for effect. But if you put it on a log scale, what this shows is Renaissance has never had a down year. Their average compound annual return is just over 66% a year since 1988. That's in their medallion fund. So if you put $1,000 in medallion in 1988, it'd be worth around $2.4 billion today. And not to mention, they lose a lot less, even in times of stress. Actually, a lot of these funds do better in times of stress because a lot of their short-term trading strategies end up capturing a lot more edge out of essentially people making rational or irrational decisions. So how do they do this? Well, clearly spoiler alert, I'm here to talk about technical analysis. But before we dig into the technical analysis and the charts, I want to just take it one step further to build it up conceptually. So whether you're a value investor, you're using quantitative strategies, you're using flows-based strategies, whatever, more often than not, unless you have some form of structural edge, you're going to end up deploying a strategy that has a fairly small edge. You're going to need to have the law of large numbers unfold in your favor. And a great analogy for this is blackjack and like counting cards. I'm sure a lot of the folks in this room are familiar with that. Blackjack is the game of 21. If you are a good card counter, you effectively flip the house's edge into your favor. But if you're the best card counter in the world, and you sit down, you play 100 hands, your edge is only about 2%. It's not that much. So after 100 hands, you might be up, you might be flat. You have a good chance you might be down. The law of large numbers has to come into play. You play over 5,000 hands, it's really going to start to materialize. You're going to start making some money. But this all can unfold in very, very different paths. And that's important for a reason. So we simulated this, simulated a 2% edge, 5 different sort of simulated players. And if you take a closer look, they're all kind of generally going in the same direction. They all have different, paths that they're taking. But if we take a little closer look at their stats, so player 1 averages about a 10% return after every 100 hands. Per 100 hands has about standard deviation or volatility for around 11%. It's sort of a quasi-metric when we're talking things like this. But the important thing I want to point out is his max drawdown, his peak to trough decline at any point over his 5,000 hand session was 37%. Player 2, a little bit better return, but had a max draw and lost over half his bankroll at one point in his weekend session playing in Vegas. Player 3, generally the same, and this is what I really wanted to get to, is player 4. Now this is perfect card counting. This is a well-defined 2% edge. Average return, still made money, but at some point over the weekend, he lost 85% of his bankroll. It's a lot like me with GE and ocean freight. And player 5, still had a pretty big drawdown. But the point I want to make with player 4 and player 5 is, if you have a small edge, which everybody in this room, unless we're directly next to the exchange and we can do high frequency and make money every minute, every day, every month, every year, you're extracting something that has to play out over long periods of time. And you don't know what's going to come next, and you don't know what the outcomes actually might be. So, and if I was down 85% and I was the best card counter in the world, I'd even start having some doubts about how effective my methodology was. Now, what the Harvard guys and MIT guys did that was genius, and when I say the Harvard and MIT guys, they were sort of made famous. There's a book written about them about bringing down the house. They went out to Vegas. They made a ton of money doing it. But they'd go out there as a team, so they'd pool all their money in the beginning. They'd all go out to the tables, they'd play, and then they would pool it all at the end. Well, as a team, they all end up getting the average return. The volatility comes way down because they're all uncorrelated when they're playing at different tables. And the max drawdown at any point in the night or the weekend for the team, it's only 15%. It's less than half of the best outcome, which was player one. And if you grasp, and so I'm pointing out, I'm showing average return over volatility, Sharpe ratio. The best Sharpe ratio of all of them was player three at 0.96. This is an order of magnitude higher than that. It's certainly an order of magnitude higher than player four and player five. And if you graph out that equity curve of the team, it's a much smoother ride, a lot less variance, but you still get the result you're going after. And this is what these best-in-class quant funds and what we're striving to do. We're trying to replicate this math. We're trying to do this. So where does technical analysis come in? Finally getting to it. Well, like I've said, these best-in-class funds, they trade many, many different strategies. Over different time horizons, they trade different markets. And all of these strategies I've listed up here, kind of on this football field chart, they range based on their trade horizon. So all the way at the far left, you have like high frequency trading, which is intraday, even intrasecond. You move up to daily, weekly time frames. We're talking statistical arbitrage, swing trading. You move into more of the months, quarters, years time frame, trend following, forex and commodity carry, momentum strategies. And then we move into the much longer term, the yearly or even decades long or perpetuity strategies. We're talking value, even buy and hold and rebalance. Those are long-term strategies. They do have an edge. They're capturing that edge. It just takes a long time for it to play out. So if you look a little bit closer, about half the strategies up here use price, almost exclusively price, but also sometimes volume, as their primary inputs for generating signals. There's no fundamental data going into statistical arbitrage or swing trading. It doesn't come out fast enough. Same thing with trend following momentum. You talk to the best-in-class trend followers, they'll tell you, all we do is watch price, we follow price. So what are all these strategies doing? They're exploiting the first principles of what we call first principles of market dynamics. You see this across markets. You see this across different time horizons, different periods of history. Over decades, call it quasi-decades, 7 to 15 years at a time, markets tend to mean revert. They tend to go up, they reach an extreme, they tend to revert back down, reach a lower extreme, and on we go. What we call these normally is the market cycle. If you kind of zoom in, once we're talking months, quarters, years, markets tend to trend. They exhibit momentum. They have a positive serial correlation. And then you zoom in a little bit further, and you're talking daily, intraday, weekly, the markets tend to chop up and down once again. It's almost this fractal design of markets and how they operate. So why do markets do this? I had a great conversation with Jerry Parker, who's a world famous trend follower. He runs Chesapeake Capital, was one of the original turtle traders. He has a great story. But I said, Jerry, you follow price. Is this mainly, are you making money off of behavioral decisions? And he said, in part, but the vast majority of it is fundamentals. And here's somebody that doesn't use fundamental data at all. He only follows price. And I thought about that a lot, and he said, well, if you think about it, fundamentals tend to trend. They in themselves actually tend to trend. And there's a great explanation for this. George Soros had this theory of reflexivity. So for instance, if you look at just like a base level individual stock has good earnings, a couple quarters, pushes the price up. Now there's a behavioral dynamic. There might be some flooding into that to push the price up even further. But once that stock price goes up or goes up enough, they start to be able to use that stock as currency. They can go make accretive acquisitions using their shares as a tool for acquiring any competitors to integrate vertically, horizontally. They're making these wise decisions in terms of acquisitions, increases their earnings per share, their fundamentals improve. Stock price goes up further. Well, now they're starting to gain more market share. They're starting to be more profitable. They get better terms of their lenders. Their interest costs go down. Their liquidity improves. And this feedback loop continues on and on and on and produces these trends. Now, what we've seen recently, especially like in the tech space, is sometimes it can go a little too far. We saw this in 08 and 09. We saw this in the dot-com era. And what ends up happening is that sort of virtuous cycle can turn into a vicious cycle on the way down. Will they do this going forward? We tend to think so. We think that because there is this fundamental and behavioral tie, it's unlikely that this will, dissipate going forward. And to hop back, if you look at the short term, nobody knows for sure. There is no definitive answer to what the fair value of any stock or bond or currency really is. And I tend to think of it kind of like, when you go to the doctor's office and you get up on the scale, and and if anything changes, if you take your shoes off, or if the dial on that is always trying to seek out where that equilibrium is. Markets are always changing. That scale is always changing. So it's always going to be seeking out what that fair value, what that correct number is. And that's sort of what markets do in the near term is new information comes in, or even no new information comes in, just traders are making trades and it's pushing prices from one extreme to the next. So we do believe this will proceed into the future. And so finally getting on with the deeper dive on the technical side. So here's how we define technical analysis, at least within RQA. Source data needs to be price and volume, essentially exclusively. Must be quantifiable, must be testable, which means no technician fortune telling. It has to be something where we can load it into a computer. Everything we get is objective, not subjective. Now, don't get me wrong. Charlie Day might be onto something here. And we know people, we've talked to people that have very discretionary processes using technical analysis, and they're very successful with it. It's just not for us. I don't trust myself. So what is technical analysis ultimately doing? Well, it's trying to denoise data. It's trying to standardize data or make it more stationary, because price alone can be very noisy. And at the end of the day, what we're trying to do, whether you're a value investor, a technician, or a quant like me, you're trying to determine, is this price going to keep going in the same direction, or is it going to change direction? That's it. Where is it going to be at some look-forward period, whether it's next day, next week, next month, next year, next 10 years? And what we'll do, two quintessential indicators that most people use, moving averages. It's a great way to denoise data, get a clearer picture, to smooth things out. And you can use the slopes of those moving averages, or you can just say the underlying price is above or below it. Another one is like a MACD up here. Another momentum indicator also helps in identifying inflection points. Now, a lot of people and myself included as a kind of a skeptical person, would say, well, it looks great, it seems intuitive, but where is it in the data? So this is a very simple factor analysis on the 10-month moving average. So what I have here is monthly data on the S&P, on the SPY ETF. I've got a 10-month moving average. There's nothing special about that. It's a quasi indicator for like the 200-day. So this top chart in orange, sorry it's UVA colors, but what this is showing that if the S&P closed under the 10-month moving average at the end of last month, the average return the following month is a little less than 20 basis points. But if it's over the 10-month moving average, closed at the end of last month above the 10-month, the following month on average is right around 100 basis points. Not to mention, we were talking about Sharpe ratio earlier and volatility, annual standard deviation. When it's under the moving average, it's around 23, 24% in annualized volatility. When it's over the moving average, it's about half that, about 12. So if you're only invested in the S&P 500 when it's trading above its 10-month moving average, you should expect a much higher Sharpe ratio, and we see that in the data. Much higher expected forward-looking return, much lower expected volatility. If you actually drill into the S&P 500 itself, and we did this on current and past issues, so things that have been delisted, things that have left the index, but we wanted to make sure that we weren't having any survivorship bias. And we were saying, well, what's a really good way to say, hey, this is in an uptrend, and nobody can argue against it? It's reaching an all-time high. I don't care if you're using short-term technicals or intermediate term or long-term, if it's at an all-time high, I think by definition, it's in an uptrend. And then we were like, well, how do we turn it into a factor analysis and kind of rank them? And it's like, well, how long has it been since it hit its last all-time high? If it's been a really long time, all else equal, since it hit an all-time high, you can probably say it might be in a downtrend. Just naively, you could say it's probably worse off than something that's made a new high in the past 10 days. What this is showing is, this is a count from 0 to 10, 10 to 20, 20 to 30, 30 to 40, 40 to 50. The 40 to 50 bucket captures everything else in excess of 50. So it's saying if it hit an all-time high within the past 10 days, what's the forward expected return over the next month, the next 20 trading periods? And it's around 43 incremental basis points. So this is D-trend, this is D-meaned. What that means is you're analyzing a stock, on average it makes about, say, 10 basis points a month. That means it's 43 basis points in excess of that average of 10. But the far right, when it's 40 days or more since hitting an all-time high, meaning that it's likely falling away from its trend, it's about 30 basis points of underperformance. And in the example I just gave, so it's if it's an average of 10, then that means on average it's going to be negative 20 basis points. Does that make sense? Quantifying mean reversion. Mean reversion tends to happen, like I said, at like the really long time scales and at the really short time scales. Using technical analysis, at least in a quantitative framework on really long time scales, is difficult, especially from a mean reversionary perspective. It's better to use something like value. But if you're looking short term, you're looking daily, weekly, intraday. The example down here, and this is one of the indicators that we look at, is RSI. I know that the labeling is kind of bad, but basically it detrends and stabilizes the oscillations of those noisy price moves up above. Quantifying, is it reached a low, a near-term low in terms of its relative range, or a near-term high, or something in between. doing a similar factor analysis we did a 6-period RSI. There's nothing really magical about 6-period. I don't know why we operate with like even numbers, so we'll do like 2, 4, 6, 8. You can also do this with z-scores or a whole host of other mean reverting sort of oscillators. Stochastics are another one. But what this shows is if the 6-period RSI is in the range of 0 to 20, so really low. We've had a pretty near-term price decline. Over the next 5 days, we would expect about 100 basis points of outperformance over the average. And on the opposite end of the spectrum, when it's in the high end of the range, 80 to 100, we should expect 60 basis points of underperformance relative to the 5-day forward-looking average. And we love to see this stair step because it shows some level of causality. There's a very strong correlation here showing, the mean reversion signals that you get from indicators like this, they're actually tradable and valid. So we're not the only ones that think about this stuff. There's a great book if you're into quantitative investing or technical analysis, or you ever want to learn more about Renaissance technologies. They're the one with the vertical price chart I showed earlier. And there's a few quotes in here that I have from their book. And this one basically is, we make money from the reactions people have to price moves. Their medallion fund, their average holding period's around 2 days. Now they trade thousands of different strategies, but most of them are based on a price at their core, and they've enhanced them with alternative sources of data. They've generated algorithms that read news feeds, they get sentiment data. They download over 1 terabyte of alternative data, I think, every few months. And back to creating objective measures and not, you can data mine a little too easily with a lot of this stuff, so you have to be careful. From our perspective, you want things to kind of make sense, whether it's from a risk perspective or a behavioral perspective. But here's another quote from the book, volume divided by price change 3 days earlier, yes, we'd include that. But not something nonsensical like the outperformance of stock tickers starting with the letter A. You can drill down the data and you find out that all the tickers that outperform, the ones that have A at the front, those just tend to do better, let's trade that. It's not really something that you could, get behind. And these guys didn't either. But something even as esoteric as volume divided by price change 3 days earlier, if it was statistically significant, they'd layer it in. So let's have a little backtest fun. We're going to show some of the results of similar strategies to the factor analyses I outlined just a minute ago. And if we start with like a simple trend breakout strategy on the S&P 500 stocks, this is not all-time high. We figured we could change it up a little bit. Let's do 252-day high. And to make it into a strategy, how many positions are we going to have? Like how big can the portfolio get? We limited it to 25 total positions. And when do you get out of a stock? Hits a 252-day high. When do we get out? Crosses below its 50-day moving average. Equal weight the portfolio. I think the average hold period in here was around 100 days. You had some positions that went well over multiple years, and a lot of positions that got out within 10 to 20 days. The hit rate, I think, was you win about 40% of the time, you lose about 60% of the time. But when you win much, much larger than when you lose. But if you look at the stats up at the top, the blue line is better than the green line. We're comparing it to the S&P 500 total return. You outperform the S&P 500 by about 270 basis points, with about a third less the volatility, and basically around less than a third of the maximum drawdown. Looking at a momentum strategy, talking global asset classes, we did 7 for this analysis, which were U.S. equities, EFA, emerging market equities, the long bond, I think it was the Bloomberg Commodity Index, US REITs, and gold. We basically said, look, what's going up the fastest in terms of rate of change, just absolute return, what's done the best over the past 6 months, equal weight of 4 position portfolio across the top 4 asset classes. It beats an equal weight portfolio by almost 3%, same level of volatility, and you shave off about 25%-ish on the drawdown side. Again, a momentum, just technical, price-based strategy. These are some of my favorite, the mean reversion short-term strategies. We found that the shorter the duration of your trades, all else equal, the higher your Sharpe ratio tends to be. You just get a lot, it's like counting cards, you get a lot more, lot larger sample size. So what we did here, it's not labeled here. This is akin to the 6-period RSI. This one's going long and short. I think the only cheat here is we've layered in like a 200-day moving average saying you only go long if the stock is above its 200-day moving average, and you only go short if it's below its 200-day moving average. You outperformed the S&P 500 buy and hold. That was 10 positions, 10% in each. You outperformed the S&P by about 300 basis points. Again, a third less the volatility, and only a 12.8% drawdown as compared to the S&P's 51. Are these all curve fit? We've all seen beautiful back tests in the past. I wouldn't try to slip that by you guys. So this is a trend. We call them ensembles. So you run many different variations of a strategy. Instead of the 252-day, you do 250 or 150 or 100, or as long as you're just trying to capture that trend. And the exit criteria, we did the 50-day moving average in the prior example, but this one's like 10-day, 20, 30, and you end up with hundreds of different variations. And they all kind of do similar things. Some are better than others. We found that it's very difficult to select which ones are likely to do better than others. So what we tend to do is try to trade a portfolio of them. Same thing on the global momentum side, changing up all the different parameters, different ways of calculating momentum. We also threw in momentum long short. This is sort of more of like a replication of a CTA. As you can see in periods like 2008, 2009, tends to do better. Recently is on a pretty good run. I think they've been short rates all year. But again, another robust strategy, and there's lots and lots of different variations. There's no really secret sauce. You're just trying to trade and be generally correct in capturing some market phenomenon. Mean reversion, it's a little bit wider spread, but they all tend to be going in the same direction. The ones down here at the bottom still have positive return generation. The reason why they're so low is they just don't get a lot of trades. You've made the extremes so hard to get in, so it's rare when they actually get positioned. So it's more of an exposure thing. They're actually not building out their portfolio as readily as they should be. And what's great about this is sort of a hidden benefit of technical analysis. You can create these new different strategies, and they're largely uncorrelated to one another. So you get a lot of diversification benefits out of it. And when you put them all together, this is the reason why I outlined the blackjack team before. If you can come up with minimally correlated bets and you put them together in some kind of portfolio, and what I've done here is I've started with a 60-40 portfolio. We equal weighted all 5 of these, so you've got sort of a beta exposure and then these different alternative exposures based exclusively on technical signals. And you end up with something that's far greater than the sum of the parts. And you end up with basically the average return across all the strategies. But because of the diversification benefits, you eliminate a material amount of the volatility. This is around 30% less than the volatility on the 60-40. And the maximum drawdown over the period is less than 10%, whereas the 60/40 is about 28%. And what the quant funds love to do is they like to target a volatility, they like to scale it up. Because if they're comfortable with a certain level of risk and they're able to scale things accordingly, they can produce much higher gross returns, and even after their fees, generate a pretty solid result for their clients. The thing that we're really excited about these days in sort of a treading lightly is the way I'd like to put it, is there are all these new products coming out with capital efficient characteristics, AKA built-in leverage. But if you use them appropriately, you can actually, even in retail portfolios, start to create more of this dynamic. Not necessarily scaling to this degree, but marching in that direction and maintaining a lot of diversification. So I hope I've convinced you that technical analysis is useful. We think it is. We think that there's material amounts of alpha generation, excess return generation that can be deciphered through price and volume patterns. I think it goes without saying that even just using technical signals as a risk management tool to set stops, exit criteria, or even on the diversification side, creating strategies that are uncorrelated to what you're already doing and reaping the benefit by layering in something that's different than what you're already doing. And not to mention, these guys up here share a lot of our same views. And many of them, a lot of these guys we've talked to, haven't talked to them, but they're a little more secretive. But essentially they're like, yeah, it's lots and lots and lots of simple models. And just keep it robust. Don't curve fit. You have to be really, really careful to not layer in too many rules. But a little simplicity and trading something a little different can go a long way. That's all I've got. Thomas?
So the U.S. market is, the S&P is kind of a weird beast because it's almost a momentum index.
Right.
And have you tested these strategies on foreign indexes or equal weighted indexes, and do they give similar results?
So in terms of like at the index level, or are you talking drilling down into individual stocks?
Well,
The individual stocks we've not. But if you look at the MSCI EFA index or the emerging markets index, it works. We just haven't essentially subscribed to get the underlying data for all the international and emerging markets. We just haven't graduated to that level just yet.
Could you touch on kind of turnover and transactions costs and those types of strategies?
Sure. So the trend, like the breakout stock trend stuff and the mean reversion trading, we built those in. We built in the assumed commissions. It doesn't assume any slippage or anything like that. So there would probably be a little degradation there. And the commissions that we built in are generally an average of what we've experienced over the past 5 years. I will caveat that with the past 5 years in terms of commissions have not been the same as what was experienced in the 90s and early aughts. So there would be probably a little bit more degradation there. But then at the same time, back in those periods, these signals had a lot more juice behind them. The problem that we have and a lot of these funds have is these sort of signals are kind of like a sieve. They tend to deteriorate slowly but surely over time. They're still effective, but you have to keep a rolling eye on, how that edge is holding up over time.
signals, especially technical, in this case they're time series signals.
Yes.
Comparing individual stock to its history. And but often the signals are combined cross-sectional. You're trying to beat your cross-section. And when you combine, I see the issue of time series signals versus cross-sectional signals. How do you combine them together?
Yeah, that's a great question. You can, so for it, like the momentum strategy, the global asset one, that was a cross-sectional. They are, competing against each other for an allocation. You can combine them by having a cross-sectional signal like a momentum rank, but then you can also have a time series, like a filter that says, if these, you're doing it on the global asset classes, and it's like, well, if the global asset class is trading below its 10-month moving average, don't include it in the ranking. So there are ways that you can combine signals like that. Same thing with like the mean reversion stuff. So what we'll do is we'll say, is it above a moving average or below a moving average? And has it breached below this low threshold or breached above this high threshold? Oftentimes, especially when markets sell off like they have this year, you'll get a whole lot of signals on the same day. And you're saying, well, I only have slots for 10 of these guys. Then you start having to rank them based on, you can use the same indicator, which one, give me the ones that are the lowest, or you can start using other things that go into the mix to give you a slightly different or a diversified signal. Did that answer your question?
Yeah, and do you scale them in terms of volatility? Like again, you have 10 stocks, each of them will have different vol.
Yep.
All of them have RSI shining through the roof.
Yes. Yeah, so that's actually one great way we've discovered to just off the bat enhance your Sharpe ratio. All of these were really simple, equal weight. But if you scale based on volatility, essentially common sizing every trade that you're going to do. So, crude is a lot more volatile than the US dollar. Well, you're going to trade crude a lot smaller than you would a US dollar position. You essentially common size or equal size their effective bet. And when you do that, it enhances your Sharpe, you reduce risk. And we do that across essentially every strategy we do.
What's the difference between trend following and momentum? And then second question, on the previous slide, it looked like the mean reversion was actually superior to the enhanced. Why not just go all in with that strategy?
So I'll answer that first. We don't like to place large bets or bet the farm on any one strategy. We have this, the way that we think about things is don't put too much reliability in a model. Do not rely on a model by any extent. Because if that edge goes away, or if some new large player comes in and really eats up that edge, you're kind of, you're stuck in the mud. So what we do is we like to diversify across different time horizons, trade short-term strategies, intermediate-term strategies, long-term strategies. Diversify across asset classes, diversify across different direction. That could be long, short. That could also be strategies that are like mean reversion is effectively the exact opposite of momentum and trend. We want to have things that behave very, very differently to extract a different return profile. So when we talk about trend following versus momentum, it somewhat goes back to the whole time series versus cross-sectional way of looking at things. So trend following, by and large, and there are people that do both, is what we call absolute momentum. So is this trending higher or is this trending lower? I don't care how fast it's going in either direction. I just care the general overall direction. And if it's heading up, I want to be long. And if it's going down, I want to be short or I want to be flat. Momentum is saying, okay, I have all these different assets, and I'm going to create a horse race out of them, and I want to be riding the horses that are going the fastest in the direction that I'm focused on.
You mentioned that the signals go over time. So is it, how much of that is because of changing investor behavior versus the quant exploring?
That's a great question. We've actually seen that certain edges, they do decay over time, but they also ebb and flow. They will come back. I think a lot of the time is that people abandon the strategy. As the edge starts to vanish, capital leaves that strategy, and then sure enough, the edge tends to reappear. As there are more persistent dollars, as there are more dedicated dollars that will always be focusing on a strategy and know about that sort of decay and come back, if there is more capital chasing that, if it's always a persistently crowded trade, then you should expect that edge to remain sort of subdued. Did that answer everything, or I feel like I'm missing a part? No?
How much of investor behavior changes?
That's a good question. I like to think that investor behavior doesn't change a whole lot. We get the question all the time where it's, well, with more algorithmic trading out there, I think there's statistics floating around that's 80 or 90% of all trading volume every day is algorithmic trading. Most of that is arbitrage trading, that's high frequency trading, that's market making. We say that markets tend to be micro efficient, but macro inefficient, which means if you're trying to arbitrage the NAV of an ETF to its price, that's an arbitrage opportunity that you can trade around, and if you're fast enough, you can make a good amount of money doing that. Same thing with cross exchange. If the price on the London Stock Exchange is different than the New York Stock Exchange, those are very, very difficult edges to capture. But that's micro efficiency. And that's where most of that trading volume is being done. And then when it comes to looking at days, weeks, months, years, we're talking strategies that have human beings behind the controls. And even if the strategy is systematic and is quantitative data driven, if the strategy is having a bad period and capital leaves it, those are human decisions, whether it's the PM saying, take this offline, or it's a fund shutting down because the investors have had enough of suboptimal performance. So at the end of the day, even though certain strategies are mechanical, what we find more often than not is the vast majority of capital is still being directed by human decision making.
Well, John, thank you. And I don't see Ellen in the room, but when you're walking out, thank her. She's the one who coordinates all these events. And mark your calendar, December the 13th at River City Roll. We're having a happy hour starting at 5 o'clock. So hope to see all of you there. And happy Thanksgiving. And again, thanks, John.
Thank you. Thanks
you.
everybody for coming out.